Ontario Premier Doug Ford threatened to shut off his province's electricity exports.
We will not hesitate to shut off their power as well.
Ontario didn't warn anyone. It just pulled the plug. Overnight, a sudden surcharge was slapped on every megawatt flowing into the U.S. No explanation, no heads up. Then came the headline, $5 billion in unpaid energy bills. But that was just a distraction for a bigger, brutal, and calculated strike in a growing trade war. Now Washington is reeling. Governors are fuming. CEOs are scrambling to secure backup grids. But Ontario, it's already shaking hands with Germany, South Korea, and Vietnam, moving forward while America looks backward. So, why did no one stop this? How long has North America's energy balance been quietly shifting? And what happens when the country you depend on has already moved on? Stick around, because the real story is far from what the media has told you. Electricity as a weapon of retaliation. What if the biggest threat was not foreign competition, but domestic betrayal? To many Americans, Ontario was a cooperative neighbor, a silent partner in keeping the lights on. When Premier Ford imposed the 25% surcharge on electricity exports, that partnership transformed into a pressure point. At a grid monitoring center outside Albany, Jason Tran's dashboard erupted with alerts. His team at the New York Independent System Operator watched as import costs rose in real time. 6% of New York's electricity came from Ontario. That percentage might not seem large until prices jumped, and no alternative supplier could fill the gap on short notice. For households, the price surge was not immediately visible. For industrial plants, data centers, and city infrastructure managers, it was immediate and punishing. The surcharge translated into up to $400,000 in added daily cost across the affected states. More than 1.5 million homes and businesses across the United States felt the shock. This move was not arbitrary. Ford knew electricity could not be tariffed under the United States-Mexico-Canada Agreement. That loophole made it the perfect target. By taxing exports directly, Ontario was not violating trade law, but it was upending precedent. Officials in the United States condemned the measure as dangerously short-sighted. Ford insisted it was long overdue. As grid operators scrambled to balance rising prices and supply forecasts, deeper cracks began to form in a system no longer built for trust. The phone call that changed everything. Everything changed with one conversation. Hours after the surcharge took effect, pressure mounted across the United States. Phone lines lit up in Ontario's Ministry of Energy, many from furious governors seeking relief. But one call from United States Secretary of Commerce Howard Lutnick to Premier Doug Ford altered the trajectory of the standoff. It was not an apology, it was a proposition. Suspend the surcharge and enter discussions. The administration of former President Donald Trump offered to review tariffs on steel and aluminum in exchange for Ontario standing down on energy. Premier Ford, having previously vowed to hold the line, shocked both allies and critics. Within 24 hours, he reversed the surcharge decision, temporarily. News outlets framed it as a retreat. But in government strategy sessions on both sides of the border, the maneuver was seen in a different light. Ontario had proven it could hit infrastructure instead of ideology. Without touching a single pipeline or refinery, it had threatened regional stability. The Trump administration, accustomed to initiating trade drama, was now racing to contain the fallout. The lights stayed on. The wires kept humming. But beneath the surface, confidence in seamless trade had already dimmed. Still, it was not just grid stability that had been shaken. The foundation of a century-old alliance was beginning to fracture. The phone call that changed everything. Everything changed with one conversation. Hours after the surcharge took effect, pressure mounted across the United States. Phone lines lit up in Ontario's Ministry of Energy, many from furious governors seeking relief. But one call from United States Secretary of Commerce Howard Lutnick to Premier Doug Ford altered the trajectory of the standoff. It was not an apology. It was a proposition. Suspend the surcharge and enter discussions. The administration of former President Donald Trump offered to review tariffs on steel and aluminum in exchange for Ontario standing down on energy. Premier Ford, having previously vowed to hold the line, shocked both allies and critics. Within 24 hours, he reversed the surcharge decision, temporarily. News outlets framed it as a retreat. But in government strategy sessions on both sides of the border, the maneuver was seen in a different light. Ontario had proven it could hit infrastructure instead of ideology. Without touching a single pipeline or refinery, it had threatened regional stability. The Trump administration, accustomed to initiating trade drama, was now racing to contain the fallout. The lights stayed on. The wires kept humming. But beneath the surface, confidence in seamless trade had already dimmed. Still, it was not just grid stability that had been shaken. The foundation of a century-old alliance was beginning to fracture. Grid shock. Across state lines. This was not just about electricity. It was about survival. Across border states like Michigan and New York, municipal offices, manufacturing plants, and small businesses saw their budgets shift overnight. In Buffalo, restaurant owner Tasha Meyer opened her electric bill and froze. Her baseline rates had risen by 12%. She was already paying inflated prices for ingredients and insurance. The surcharge turned a fragile margin into a monthly loss. Industrial processors and municipal utilities felt the squeeze even harder. Cities had locked in supplier contracts based on stable Canadian energy inputs. Now those contracts were under financial stress. In Minnesota, a waste treatment plant operator submitted an emergency funding request to keep systems running as grid prices surged. In Albany, policymakers calculated the cost of offering state-level relief and were stunned by the totals. More than 1.5 million homes and businesses were directly impacted by Ontario's surcharge. The average household never saw the policy briefing. They just saw the bottom line change and demanded answers. Local politicians began asking why their states were so reliant on a province that could change the rules without warning. Energy security became a dinner table topic. Those questions would soon have global consequences. Assembly lines go dark. It began with a delay at the Windsor-Detroit border. Then came the halted trucks. Then silence. Ford's Kentucky truck plant stopped production when a key Canadian-made fuel pump assembly failed to arrive. At General Motors in Arlington, missing brake sensors grounded full-size SUV lines. Chrysler's Warren facility in Michigan ran out of Ontario-supplied wiring harnesses. Everything slowed. Then it stopped. The North American auto industry runs on just-in-time logistics. It is not designed to store parts. It is designed for flow. When a supplier's energy bill spikes and they suspend operations, downstream assembly lines grind to a halt. The entire system, built for efficiency, collapses under pressure. By the end of the third day, hourly losses across the United States auto sector had crossed $10 million. Each major facility impacted was burning approximately $1 million per hour. Executive teams rushed to find alternate suppliers. There were none. These were not generic components. They were vehicle-specific and often country-certified. In a Southfield logistics hub, a procurement officer stared at an empty schedule board. "We used to have 12 arrivals a day from Ontario. Now it's 0, she muttered. The industry that built the modern economy had suddenly discovered its weakest link. And this time it was not labor, it was power. The green edge Ontario held that not all disruptions were reactive. Some were strategic. Ontario had spent the last 5 years investing heavily in its electric vehicle supply chain. While other governments debated subsidies and standards, Ontario broke ground. Gigafactories, mineral extraction permits, battery research centers, they all came online fast. The Stellantis LG Nexstar plant in Windsor became a cornerstone of North America's battery future. Ontario controlled lithium and cobalt from its northern mines and had existing routes to process and export those materials to South Korea, Germany, and Japan. For once, the future did not go through Detroit. It went through Sudbury and Thunder Bay. When Ontario redirected shipments of rare earth materials toward European partners during the energy standoff, it sent a message louder than any tariff. It told the world North America's energy future did not require Washington's permission. Inside a Zurich boardroom, an executive from a European EV startup signed a 5-year supply agreement with an Ontario mining firm. Reliable, neutral, and forward-looking, she said. That's what we need. While American auto giants stalled, Ontario advanced. They were not just cutting off supply, they were redefining who gets to shape the future. America's miscalculation. It began with tariffs, but it did not end there. The administration of former President Donald Trump believed imposing a 25% tax on Canadian steel and aluminum would bring production back to American soil. Instead, it triggered a cascading set of retaliations that exposed America's dependence on its northern neighbor. Grocery manufacturers faced higher packaging costs due to the increased price of aluminum cans. Construction firms delayed projects as steel rebar quotes rose. But it was energy and auto where the full impact hit hardest. American supply chains were not flexible enough to adjust. Automation could not compensate for missing parts. Domestic factories could not replace Canadian capacity. And when Ontario targeted its energy exports as a pressure point, it hit consumers directly, not corporations. Public support for the tariffs began to erode. Opinion polls in Michigan and Ohio showed a majority believed the trade policies were hurting their local economies. Governors, initially quiet, became vocal critics. New York's governor called the energy surcharge a warning shot that we ignored. Meanwhile, Ontario's government played a new narrative, that it had been pushed into a corner and acted decisively. Premier Ford appeared at a press conference alongside EV entrepreneurs, pitching Ontario as the stable backbone of a modern industrial economy. Trade policy, once abstract, had become personal. American consumers, workers, and executives were now directly affected, and they were beginning to realize the real cost of underestimating their neighbor. The consequences of that realization would not remain domestic. The whole world was watching how America would respond next. The grid that can't be cut? The math looked clean. Ontario could turn off the power. No law said it had to keep exporting electricity. But the reality was far messier. The province's electrical grid was engineered around consistent flow, not isolation. Nuclear plants cannot be paused like a factory shift. Hydroelectric dams cannot be throttled without wasting energy or flooding riverbanks. Cutting the wires to the United States would mean rerouting an entire system built on cross-border exchange. Leila Fakhri, still working in Toronto's Grid Command Center, received the directive: run a blackout scenario. She loaded the assumptions into the simulator and watched the warnings flash red. Load mismatches, frequency drops, emergency reserves depleted. Ontario relied on those export lines to balance nighttime overproduction and offset peak demand. Cutting supply to Michigan and New York would trigger domestic chaos by week's end. The simulator revealed something else too. Ontario's grid was physically stable, but politically exposed. Any unexpected pressure could lead to a confidence crisis. Homeowners might overconsume in panic. Traders might spike the wholesale market with speculation. Municipalities might escalate emergency protocols before power even failed. That instability was invisible until it suddenly wasn't. Meanwhile, grid operators in the United States modeled the inverse. Could they survive without Ontario's power? In rural New York, the answer was no. In downtown Detroit, it was maybe. In northern Minnesota, it was already too late. Hospitals and data centers would be the first to face rotating outages. Every hour of modeling revealed a paradox. Both nations needed each other's energy to preserve their own grid stability. The illusion of independence was just that, an illusion. So both sides hesitated. What sounded like a political maneuver revealed itself as an engineering impossibility. Yet the idea had been voiced, and that alone changed everything. Oil is the nuclear option. Electricity was dramatic, but oil was decisive. Behind closed doors in Ottawa, Canadian officials debated a step further, reducing crude exports to the United States. Alberta's pipelines carried more than 3 million barrels per day southward, including the heavy crude that American Gulf Coast refineries were built to process. Without it, refinery yields plummet and gasoline prices skyrocket. Some ministers argued this was Canada's ultimate leverage. Unlike electricity, oil was flexible. Storage existed. Markets in Asia were hungry. The Trans Mountain Expansion Project had recently opened access to Pacific shipping routes. Redirecting even a portion of supply to China or South Korea could send shockwaves through American fuel markets. At a refinery in Houston, Operations Chief Jorge Ramirez reviewed contingency reports. We can handle 1 week of disruption. After that, product losses go vertical. It was not just gasoline. Canadian crude feeds the raw materials behind plastics, aviation fuel, chemical solvents, and fertilizer. Downstream industries that appeared unconnected would face rolling shortages within days of disruption. Fertilizer prices in the American Midwest, asphalt in the Southeast, jet fuel in New Jersey. All of it tied to flows from Alberta. The United States was still Canada's biggest customer, but Canada was now its irreplaceable supplier. That asymmetry gave Ottawa options no one expected it to use. Energy experts called it a strategic deterrent. Quiet, credible, and never meant for deployment. Yet one phrase surfaced repeatedly in strategic meetings. If electricity was the warning shot, oil is the nuclear option. Climate goals collide with crisis. Just as state leaders scrambled to manage economic costs, environmental planners faced a different threat: rising emissions. Canadian hydroelectricity was one of the cleanest energy sources flowing into the United States. When that supply was disrupted or rerouted, it had to be replaced. In most cases, that meant fossil fuels. In Massachusetts, climate strategist Alina Vasquez recalibrated projections. With Ontario's imports suspended, local utilities relied more heavily on natural gas. Carbon outputs increased by 9% in 2 weeks. That single shift was enough to derail the state's annual reduction targets. In Minnesota, coal plants scheduled for phase down were quietly restarted to maintain voltage. In upstate New York, diesel generators reserved for winter emergencies were activated to bridge the new cost gaps. It was as if the energy transition had reversed overnight. At the Regional Planning Office in Boston, engineers debated whether renewable rollouts would be delayed another year. The challenge was not just cost, it was grid stability. Ontario's clean surplus power had filled the gap on overcast days, or when wind farms slowed. Now every sustainable source needed backup from something dirtier. Cross-border electricity trade had long enabled cleaner power to reach further. Now, with those lines politically tainted, environmental progress faced new headwinds. The benefits of integration had become liabilities. Ontario's own emissions stayed low, but its neighbors paid the atmospheric price. California environmental groups began lobbying Congress to broker a long-term energy security pact with Canada. Quietly, utility companies began funding carbon offsets to cover their new footprint. And the ripple effect would not end at state borders. Trust deficit in energy diplomacy. The lights stayed on. The furnaces burned. But the sense of reliability was gone. American energy firms began reevaluating every relationship with Canadian partners. Could long-term contracts be trusted? Would politics override protocol next time? At a conference in Chicago, a United States utility chief executive officer canceled meetings with Ontario Hydro representatives. "We want partners, not pressure points," he said. The message reverberated across the border. Windsor's Economic Development Council released a warning memo. Potential loss of U.S. investment due to perception of instability. In Toronto, Premier Ford faced mounting pressure to reassure markets. He reiterated that the surcharge was temporary, but the damage was already done. In Calgary, oil executives launched exploratory talks with refineries in Singapore and India. In Montreal, tech sector lobbyists advised clean energy startups to prioritize European investors over American funds. Investors began looking elsewhere. Quebec positioned itself as the new safe bet. Manitoba launched a media campaign branding its exports as politics-free. European and Asian buyers, once hesitant to engage in North American grid dynamics, now saw Canadian suppliers as potential allies in a multipolar energy world. It was not the blackout that caused concern. It was the hint that it might happen. Diplomacy had been pierced by the possibility of reprisal. Trust, once shaken, is rarely rebuilt by policy alone. It requires time, transparency, and proof of restraint. And the world had stopped waiting. Trust deficit in energy diplomacy. The lights stayed on, the furnaces burned. But the sense of reliability was gone. American energy firms began reevaluating every relationship with Canadian partners. Could long-term contracts be trusted? Would politics override protocol next time? At a conference in Chicago, the United States utility chief executive officer canceled meetings with Ontario Hydro representatives. "We want partners, not pressure points," he said. The message reverberated across the border. Windsor's Economic Development Council released a warning memo. Potential loss of U.S. investment due to perception of instability. In Toronto, Premier Ford faced mounting pressure to reassure markets. He reiterated that the surcharge was temporary, but the damage was already done. In Calgary, oil executives launched exploratory talks with refineries in Singapore and India. In Montreal, tech sector lobbyists advised clean energy startups to prioritize European investors over American funds. Investors began looking elsewhere. Quebec positioned itself as the new safe bet. Manitoba launched a media campaign branding its exports as politics-free. European and Asian buyers, once hesitant to engage in North American grid dynamics, now saw Canadian suppliers as potential allies in a multipolar energy world. It was not the blackout that caused concern. It was the hint that it might happen. Diplomacy had been pierced by the possibility of reprisal. Trust, once shaken, is rarely rebuilt by policy alone. It requires time, transparency, and proof of restraint, and the world had stopped waiting. Strategic autonomy, by necessity. If integration makes you vulnerable, what is the alternative? That question, once unthinkable, now shaped Canada's long-term strategy. Ottawa officials quietly began exploring a path that would have sounded radical even 2 years earlier. Deliberate decoupling, not isolation, not confrontation, but resilience through diversification. At the center of this plan was energy. Canada supplied more than half of the United States' imported crude oil and nearly all of its imported electricity. That dependence had always been framed as a Canadian risk, that the United States might find cheaper, closer, or more compliant suppliers. But after the electricity standoff, the risk looked two-sided. With the Trans Mountain Expansion project completed, Canada could now ship oil to Asia at volumes previously impossible. Tankers bound for South Korea and Singapore began displacing long-haul United States orders. In British Columbia, liquefied natural gas terminals ramped up exports to India and Vietnam. Ontario sourced new capital for green hydrogen from the Netherlands, bypassing New York entirely. Meanwhile, a small coalition of prairie provinces collaborated with Japanese firms to deploy carbon capture units and convert methane emissions into reusable synthetic fuel. The deals were signed without even notifying American trade counterparts. Trade officials called it a pivot. Strategists called it autonomy. Behind the scenes, Canadian ministries began modeling what a 10% reduction in energy exports to the United States would look like. The short-term losses were real. But so were the gains: risk diffusion, global influence, and diplomatic flexibility. They also modeled the financial incentive structures for Canadian companies to take their technologies global. Export Development Canada expanded financing programs aimed specifically at helping clean energy companies open offices in Brussels, Dubai, and Singapore. The strategic shift was no longer just about defense, it was offensive. A subtle shift had begun, one that no tariff could reverse. The battle for control has begun. Every kilowatt, every barrel, every decision, now a declaration. What had once been transactional became symbolic. American auto executives no longer viewed Ontario as a stable partner. They saw it as a wild card. Ontario businesses, in turn, no longer assumed the United States was their only path to scale. They began thinking like exporters. In financial circles, this shift rippled fast. Asset managers moved energy infrastructure funds into Canadian portfolios with non-American exposure. Venture capitalists pushed green tech startups in Toronto and Waterloo to secure early deals in Europe, not Detroit. Software firms optimized for German regulatory compliance instead of United States safety codes. The signals were quiet but persistent. At a summit in Singapore, Ontario's Minister of Economic Development inked a 4-year memorandum of understanding with a Vietnamese rare earth refining consortium. Days later, a United States electric vehicle firm reported delays. Their cobalt supply from northern Ontario had been rerouted. In Saskatchewan, a private utility company began quietly selling surplus wind energy to a consortium of Nordic buyers, facilitated through blockchain-based energy credits. The contracts were written in euros, not United States dollars. Former allies began acting like competitors. Long-standing partnerships were reclassified as contingent. Every supply chain analyst was told to do the same thing: audit for geographic risk. Any dependency on Ontario or Quebec had to be documented, hedged, and if necessary, replaced. American grid operators launched feasibility studies for replacing Canadian electricity imports with domestic renewables. Washington lawmakers introduced bills to incentivize patriotic power sourcing. Some called for a national energy buffer, others for retaliatory tariffs. Ontario, meanwhile, launched a zero-emissions fund backed by sovereign capital from the United Arab Emirates. Its mission was clear: scale faster, export wider, and never again depend on one buyer. Its economy was no longer waiting for an invitation. It was setting its own table, the silence that speaks volumes. There was no announcement, no ceremony, just silence, and then a shift. In the control room at Windsor's transmission hub, Leila Fakhri monitored the power load as usual. On her screen, the export lines to Michigan ran at half their pre-crisis capacity. The rest flowed north, east, and in reserve. Nobody called to ask why. They knew. What began as a retaliatory surcharge ended as a psychological realignment. Trust had snapped, not in a dramatic blackout or loud confrontation, but in whispered decisions, rerouted contracts, and silent system redesigns. On the campus of Queen's University, an international affairs professor summarized it simply: interdependence isn't a fact, it's a choice. And once you break that illusion, everything becomes negotiable. In New York, the governor's energy team proposed legislation to require minimum domestic generation quotas. In Michigan, utilities quietly signed letters of interest with renewable developers in Iowa and Nebraska. In Ottawa, a think tank published a white paper titled Post-America Energy Security. The public discourse remained civil. The private recalibrations did not. Farmers in southwestern Ontario were approached by Dutch agri-tech companies looking to co-invest in vertical energy-neutral farming. Quebec launched a national battery storage hub, betting it could outpace California in innovation. Alberta drilled new pipelines that did not connect to American refineries. Saskatchewan and Manitoba didn't burn bridges. They built new ones. No headlines, no handouts, just independence. Quiet moves, massive impact. If you felt the shift too, drop a comment below, and thank you for watching until the very end. Saskatchewan and Manitoba didn't burn bridges. They built new ones. No headlines, no handouts, just independence. Quiet moves, massive impact. Now, was this smart strategy or a dangerous gamble? Drop a comment below, and thank you for watching until the very end.